How to manage trades in IV drops and peaks. Would you say this is an IV drop and a peak? Yeah, I would say that's pretty good. I would say this is a pretty damn good title for where we are right now in with respect to the markets and things like that. Let's take a look and see what we got. After every IV implied volatility peak and every IV trough, it may be wise to consider adjustments to strategies that were tailored for exceptional IV periods, meaning either they were too high or too low on a relative basis around norms. So it's important to note that, as shown in our studies, implied volatility experiences a significant decline in 2023 and has remained in a similar range in 2024, averaging about 15% to date. Today, we're going to focus specifically on managing the delta of short strangles in different IV environments. We're going to look at two different periods, 2016 to 2018 and 2020 to 2024. In the 2016 to 18 period, we had low implied volatility and the VIX was averaging around 14. From 2020 to 2024, the IV remained high, declined with the VIX dropping from 40% to 25% and averaging 15% in 2024 so far. What we're going to do is we're comparing selling the 25 delta, the 16 delta, 25 delta, and 35 delta strangles, 45 days to expiration, managed at 21 days. And we're going to observe the different results in each of these strangles over each time period, just to see, hey, what happens when volatility is higher and goes lower? What happens when volatility is lower and then, eventually goes higher? Let's take a look. All right. So lots of stuff here. And
Sure.
Bear with us a little bit. The most important thing when you look at this from just the first view is the win rate. And the thing that you notice with the win rate is that, and this is in periods of really low implied volatility. So we always talk about in low implied volatility, you got to be careful. All right. The win rate remains super high, 75%, 73%, 72%. The average premium, you have no context around that. So it seems like it's okay. But you start to look at the average P&L and you're like, okay, that doesn't seem like it's that much money for taking that much risk.
Sure.
And the worst loss is a big multiple of your average gain. So when you look at your P&L per trade and then you look at your return on capital, you got to be thinking to yourself, hey, I'm taking a lot of risk for an 8% return on capital or a 17% return on capital in periods of low implied volatility. Trading was tough in 2016 to 2018. Widening your short delta strikes in low IV environments can lead to higher profits. But as you scale up the delta strikes, the average P&L tends to decline. Both profit and return on capital decreases because the additional premium that you collect doesn't sufficiently compensate for the increased risk of the position moving against you. Basically, all we're saying is in low implied volatility, you got to be careful. You got to work really hard.
Yep.
And the return on capital at the bottom is something I just want you to just keep in the back of your head right here. 17, 8, and 6. Now we're going to look at a different time period, 2020 to 2024. And this time period, you can see that the win rate is virtually the same, but you can see the premium that we collect is over double. You can see that the worst losses remain the same. The buying power per trade actually goes down a little bit, but the return on capital goes from 17 to 41, goes from like 8 to 48, and from 6 to 51%. The difference between low implied volatility and high implied volatility is the difference between survival and wealth creation. You see these numbers here?
Yeah, I'm looking at them right now. 41% return on capital, 48, 51. Now you're talking to me, baby.
Go back one slide, John, for a second. Here's the return on capital in a 2-year low implied volatility period. If you did everything right, 17, 8, and 6. Then you fast forward one slide and you're at 41, you're at 41, 48, 51. Everything changes with respect to, higher implied volatility. You can sell bigger delta strangle. You can make, you can actually make some money.
Your win rate didn't change either, which was nice. So
no, the win rate doesn't change at all. In periods of high implied volatility, P&L and return on capital are higher across the board. However, scaling delta strikes, both the 25 and 35s, resulted in a significant increase in the average premium collected compared to sticking with the 16 delta strikes, leading to a better overall performance. Basically saying that when there's more opportunity, take more risk. To summarize in one sentence, heightened implied volatility conditions elevate the average profitability of all strangles, particularly those with higher delta values. Again, higher opportunity, take more risk. One contributing factor is that as implied volatility rises, it commonly results in more expensive option premiums, faster time decay, and increased premium for options with higher delta values, which is correct across the board. That's exactly what happens. Hard to do. The numbers they speak for themselves. Let's go to the next slide. So some of the takeaways here: adjusting your deltas of your short premium position in response to changes in implied volatility, whether it rises or falls, can contribute to stabilizing a portfolio's risk exposure. This is because alterations in implied volatility impact the risk and return of all deltas. And boosting the delta of a strangle can be profitable when there is high implied volatility, but lower IV environments lead to less outcomes less good outcomes when trading higher delta strangles, meaning that the returns in low implied volatility when you trade the 25 and 35 delta strangles, not very good. When you in high implied volatility, great. That's the whole difference.
Very nice. You want to know something? That was so short, so sweet, so compact, so to the point. Really made a really nice takeaway there. But you know somebody else who's going to give you a nice takeaway, Saz?